Oh, well. Okay. Seating chart. Where's my download? There it is. Peyton, can you hear me?
Yes, sir, I can hear you. I can't get my video to work, though. Can't get it to work. Can you hear me? Guess you can't.
Is my volume on? Nope. Okay. Peyton, can you hear me?
I'm talking, and it says I'm talking, but...
Yeah, I can hear you now. I had my volume off.
Oh, okay. All right. I can't get the video to work, though. I don't know why.
Can you see me?
Yes, sir. I can see you.
Okay. It's more important for you to be able to see. We'll be going through PowerPoint slides and stuff. You'll be able to see that.
Okay. All right. Well, I mean, I'll get it to work next time if I need to, but I can't get it. I don't know why it won't come on.
Don't worry about it.
All right.
Mr. Robin, can you hear me? He is connecting to audio. Okay. Mr. Robin.
Yes.
Good morning.
Good morning.
Can you see me?
I can.
Okay. I can't see you. Your camera may not be on.
Okay.
It's not essential. It's more essential for you to be able to see because I'll be putting up PowerPoint slides and that kind of stuff.
Okay.
I started the meeting a little bit early because I had no idea who might want to join early. How you guys holding up?
Fine so far.
Weird times, huh?
Really?
Hey, I'm 72. I've never seen anything like this.
Oh, wow, definitely.
Yeah. Eli, is that you? Eli, your camera is showing me the very tip of your shoulder, but not in your.
Here I am.
Yeah, there you go. I'm hearing a voice. I don't know if they are addressing me. Hey, Haley, good morning. Haley, good morning. Haley,
Hey,
hey, good. Can you see me?
can.
Good. Because you'll be looking at PowerPoint slides and stuff, and I've got a whiteboard I'll be writing on.
Okay.
It's still about 8 minutes before we're supposed to start. But,
You already working on the same phone. It was like I freaked out. It was like the day before. It was like it was like Wednesday.
I'm hearing a voice. I can't make it. Eli, is that you? And are you speaking to me?
How do you use it?
I'm hearing a lot of voices in the background, but it's just background. I'm curious, how many of you have ever taken an online exam?
I have.
And did they proctor it with ProctorU?
Yes, sir, they did.
Okay. I'm glad there's at least one that knows. And then silence fell over the room. I have no idea how many of you will actually join this meeting. But each meeting is being recorded. This is being recorded and will be posted to YouTube probably the day after.
Okay.
Paul, you with us? I'm aping him for a second to see if he responds. Paul, can you hear me?
Yes, sir.
Cool. Very good. I would try to push my camera further back so I wouldn't look as ugly, but I've got it about as far back as I can. I'm waiting a few minutes to give others time to join who will join. Some students won't join the meetings live. They'll simply look at the recording afterwards, which is fine with me, whatever works for you. Let's see, who just joined? CJ and okay. We're getting a few more people in. I'm cheating for a second and looking at the seating chart. Okay. Oh, okay. Move it up some. All right. Christopher, can you hear me? Hampton, can you hear me?
Yes, sir.
Cool. Can you guys see me?
Yes.
It's not important you see my ugly mug, but if you can see me, then you'll be able to see the PowerPoints and everything. Mackenzie, can you see me? Mackenzie. Some of you may need to turn up your volume on your computer. When I started this meeting, I actually had my volume on mute, so. Let me try something very quickly. Check 2. Y'all are going to have to deal with my bad handwriting. Can you guys see what I just wrote?
Yes, sir.
Can you make it out?
Yes.
Sorry about that. Okay. I'm giving it a couple of minutes for some more students to join. Matthew, Carmen, Tori, can you guys hear me?
Yes,
I do.
Yes, sir.
Oh, cool. Can you see me?
Yes.
Yes, sir.
Cool. Forgive me, but coffee and teaching go hand in hand.
I agree. Okay. Everything that I have that is in the form of a timepiece tells me it's time to start. First, let me tell you a change. For one thing, you were scheduled to have a third and fourth exam. The fourth was the final. Okay. There will only be one more exam. I'm folding the third and fourth together into one final exam. So, the original plan was an exam 3 for 30 points. Then the final was simply exam 4 worth 100 points. The new plan is going to have basically exam 3 will be the final, and it'll be worth 200 points. When you take an online exam, it has to be proctored. We use something called ProctorU. You'll hate it because they vet you for about 30 minutes to make sure who you are, and they make you move your camera around the room and everything, but the school does not have funding for 2 more exams. And I think this is the simplest solution. It'll cover 5 chapters, the 5 that we will have covered after exam 2. The chapter on risk, stock valuation, something called cost of capital, then capital budgeting techniques. Sorry about my handwriting. Techniques or methods, I forget which term I used. And then the last chapter will be capital budgeting cash flows. And those 5 chapters will comprise your final exam. There is no. Say again.
Will the final be on the scheduled final time, or will it be at a different time?
I think I've put it at the scheduled time. Let's peek. Little change for the class. And actually, I assumed the university would follow its final exam schedule, but the president came out with a statement that suggested it might be revised. Unless or otherwise, whoops. Well, you see, I tried to circle it. Unless you hear otherwise, it will be Friday, May the 1st at noon. It'll be you'll be allowed 3 hours for it. And that 3 hours is after they get through the vetting process.
Our original scheduled time was Monday, May 4th from 8 to 11. Is that not the correct day and time?
You know what, I've got both of them down there. Whatever the correct time was for your class, that's what I'm planning to use. I put them on both on here. Why did I do that? Yeah, Haley, if it was Monday, May the 4th at 8 o'clock, that's when it will be.
Okay.
With the final being so big, are we going to have like other grades to help guide us through the rest of the semester?
Josh, the composition is 30% multiple questions, and the other 70% will be problems that will actually be in multiple choice form. I'll talk about this later, but something I allow students to do is to use their cell phone, take a picture of their scratch work for a given problem, and email it to me for possible partial credit. But we'll talk about that later. Composition, like the first 2 exams, 30% questions, 70% problems.
Will we still be able to have a cheat sheet like we had originally?
2.
2 cheat sheets?
2 front and back, as long as we don't call it a cheat sheet. Call it a memory aid, shall we? Yeah.
Is anybody else having trouble hearing this?
Yeah.
Yeah, if y'all aren't talking, if you can mute your mic, because all of the feedback from everybody's mics being on is making it really hard to hear.
All right.
Oh, well, okay. All right. Get off of that. You guys ready to start? When we last met, well, come on, Moodle. There we go. When we last met, we were looking at the capital asset pricing model. And I thought it would be a good idea to back up and review just a little bit, because it seems like ages ago, to me at any rate, and probably does to you. If you recall, in the first part of this risk chapter, chapter 8, we looked at how diversification affects risk. And we want to throw together portfolios or stocks that have lower correlations rather than high correlations. You know, it would be better to throw together a food stock and an airline stock than to throw together two airline stocks. And we looked at the case where we just put two stocks together, two that were positively correlated, two that were negatively correlated, actually. And we observed that the negative correlation greatly lowered portfolio risk. Then we went, in fact, let me back up for that. We went to the case where we looked there it is, at what happens when you add more and more stocks to a portfolio. And I think we finally figured out that some of the risk you can remove by diversifying. Your author called this diversifiable risk. He also called it unsystematic. Then the risk that you can't diversify away is known as market risk. And if you've got as many as maybe 20 stocks, you're efficiently diversified. You're diversified enough that you don't need to add more stocks to your portfolio to further reduce risk. It won't. So we jump to what I was about to cover. Pick up with, and that's the capital asset pricing model. This is a model that assumes investors are well diversified, meaning they've got at least 20 different stocks, and they're risk averse. And it looks like this. A stock's return, a reasonable return, is a function of the risk-free rate, the return on the market, which is really, it represents an average stock, average risk stock. And for this, we use some broad index of the market, like the S&P 500. And then, of course, the big item, in the model that measures risk is beta. That's our measure of market risk. Now, the beta of an average risk stock is 1. So stocks that are riskier than average have high betas that are greater than 1. like auto producers, technology stocks. Stocks that are safer than average will have betas less than 1. Those would be companies in the non-durables industries, companies involved with clothing, food. Now the CAPM shows the relationship between risk and return. Beta is our measure of risk. R sub J on the left is our measure of return. And what it basically assumes is that investors are well diversified, they've got 20 or more stocks, and they're risk averse. The higher the beta, the higher the return they'll require. And we applied this to an example. Like, for instance, let's assume the average return on the return on an average risk stock, the S&P 500, is 13%. The risk-free rate, and we'll usually use Treasury security yields for that, is 5%. And GE, we're looking at GE. GE has a beta of 1.2, so it's above average in risk. And if we plug these values into the CAPM, we come up with a required return for beta, for GE, of 14.6%. Since the average risk stock requires 13% and GE is above average in risk, it requires a little higher return, 14.6. Now, to give you a really crude way this might be used, we've looked at GE. We believe that based on its risk, we should get 14.6. That's reasonable. If we pull out our crystal ball and we believe with a growth economy, GE would return 25%, with a recession economy, it would return 5%. And there's a 50-50 shot at each type of economy. Then our expected return on GE is 15. If we expect 15% and what we require as a minimum is 14.6, then GE looks like a good investment. If we wanted to graph the CAPM, the x-axis, the axis to the right, would be beta, a measure of risk, and the vertical axis would be our return. If we were to graph the CAPM, it would be a straight line where it intersects at the risk-free rate, and out here where you've got a beta of 1, you have the return on an average risk stock of 13%. Now, since GE's expected return is above average since GE's expected return is above what you would require, GE looks like a good investment, and the expected return would actually plot above the line. Acceptable investments plot above the security market line. And I'm not drawing this to scale, obviously, but given GE's beta, we think 14.6 would be reasonable. If we actually expect more than that, then that looks like a good investment. Now, if we tried the same thing with Amazon, let's say Amazon's really high risk, beta of 1.9. First, to find the required return, that is a reasonable return, we would run Amazon's information through the CAPM. Assuming the return on an average risk stock is 13% and the risk-free rate's 5 and Amazon's beta is 1.9, then a reasonable rate of return on Amazon would be a little over 20%. Guys, give me 1 second. Believe it or not, I'm going to turn the thermostat down. It's warm here. Sorry about that. So since Amazon's even higher risk, we're going to want an even higher return. If we pull out our crystal ball on Amazon, and we think in a growth economy, it would return 22%, in a recession economy, 12%. And with a 50-50 shot at each type of economy, our expected return on Amazon is 17%. Since we have 17% that we expect, versus 20.2, sorry about that we require, does Amazon look like a good investment? If we think a reasonable return is over 20 and we only expect 17, does it look like a good investment? No.
No.
And if we were to try to plot that on the security market line, you would note that Amazon's expected return plots below the security market line. So unacceptable investments plot below the security market line, and acceptable investments. Sorry, guys. Acceptable investments plot above the security market line. Another way to look at it, an unacceptable investment is one where the price is too high. The stock is overpriced in the market. And good investments, acceptable investments, are one where the price is too low. It's underpriced. Just another way to look at how this CAPM is used. Now you can talk about a stock's return, or you can talk about its risk premium. The risk premium, one second. This thing is not responding. Now it is, okay. The risk premium for any stock is the amount that the required return exceeds the risk-free rate. For GE, we found a reasonable return. A required return was 14.6. Since the risk-free rate was 5, GE's risk premium was that other 9.6%. I have to write slowly, guys, or the thing flies all over the page. So because of GE's risk, we require an additional 9.6% above the risk-free rate for a total of 14.6. And likewise, for example, for Amazon, here's our CAPM. And for Amazon, Amazon had a beta of 1.9, leading to a total required return of 20.2%. For Amazon, the risk premium was this 15.2%. Why is Amazon's risk premium higher than that of GE's? It's riskier stock. On Amazon, we require an additional 15.2% above the risk-free rate for a total of 20.2%. But the key thing is the risk premium is this additional 15.2. The riskier the stock, the higher the risk premium. The riskier the stock, the higher your required return, therefore, the higher the risk premium. Now, what is the risk? What is the risk premium for an average risk stock? Well, you could set up the CAPM and just plug in beta of 1. That's the beta of an average risk stock. And we would get a required return of 13%. That's R sub M. That's the required return on an average risk stock. And that's 8% above the risk-free rate. That's the risk premium for an average risk stock. But your author has another special name for that. He calls that the market risk premium. And in some problems, instead of being given the market return, you're given the market risk premium. How's this going so far? Are you following this? Is my handwriting killing everything? All right. You have some problems in your slides that are in green. I would like you to try those on your own, not using class time, such as the risk premium on Amazon. Well, I did just work that one, didn't I? But in a graphic to show that works. Here's another one involving a stock called Dolby, and I've given you some check figures. Now we need to look at the beta of a portfolio because we don't invest in one stock, we invest in several. How's the beta of a portfolio calculated? It is simply the weighted average of the betas of the stocks in the portfolio, where the weights represent how much of the total money you have in each stock. For example, what if I've got a 2-stock portfolio? I'm keeping the number low so the math doesn't get out of control. Let's say we've got $30,000 in GE, $20,000 in Amazon. So the total portfolio is worth $50,000. So what would be the portfolio beta? The weight for the GE stock, 30 of the 50, is 60% or 0.6. The weight for the Amazon stock would be 20 of the 50 or 0.4. And of course, if we don't make a math mistake, the weights ought to add up to what? 1. So the beta of this 2-stock portfolio would be 1.48. It's a high-risk portfolio because we're loading it with high beta stocks. Now, I used a small number of stocks, so it wouldn't take all day to do the math, but how many stocks should I have to be well diversified? At least what, roughly? This is where one of you can respond.
20.
20. Yeah. Do we have 20 stocks here? No, we only have 2. So we're not well diversified. So there would still be a lot of diversifiable risk still present in this portfolio.
Will you go back to the equation for the portfolio beta?
Go back to where?
The equation for the portfolio beta?
Yeah.
That's it.
See, for instance, in our example, we were using the beta for what were our 2 stocks? GE times the weight for GE in the formula, plus, that summation means add up the beta for, you can use AZ, times the weight for Amazon. Since 60% of our portfolio is comprised of GE, weight was 0.6, its beta was 1.2. The other 40% of our portfolio was comprised of Amazon with its beta 1.9. One of you needs to mute your mic. I'm getting all kinds of static or something. Anyway, that gave us the portfolio beta of 1.48. I don't know who asked the question, but whoever did that do it? Did that explain it?
Yes, sir.
Cool. All right, so just for grins. Let's try this one. See what we get. You've got the slide, right?
Yes.
Yes.
If we add this up, how much do we have in this portfolio in all? What is that, 50,000? So the weight for Microsoft would be 10 of the 50, or 0.2. The weight for GE would be 25 of the 50, which would be half of it. And then the weight for Birdseye would be the other 15 of the 50. So the beta of the portfolio would be the weight for Microsoft times its beta plus the weight for GE times its beta plus the weight for Birdseye times its beta. And you should get a portfolio beta of 1.01. Is this portfolio well diversified? Again, how many stocks do you need to be well diversified?
20.
20 or more. How many do we have here? 3.
3.
Yeah, so this is not well diversified either. Okay. We talk about the security market line like it's fixed in time. It's not. If the Fed wants to fight inflation, the Fed will push interest rates up. I don't know if you remember that from economics, but they'll push up the cost of borrowing to discourage borrowing and cut back on spending. And what happens with the security market line is it shifts up. Parallel shift. But another type of shift can occur when the market gets more nervous, such as today. And what happens is everybody's risk premium goes up, and this thing literally rotates to a steeper slope. That's what happens when the market becomes more risk averse. It happened right after 9/11. And of course, it's been happening over the last couple of weeks. Now, when is a stock's price in equilibrium? That's when the expected return and the required return are the same. And of course, we get the required return from the CAPM. So in terms of our graph, here's the graph we've been working with, where this is beta. This is the security market line. And let's say we've got a stock with a beta maybe the beta of GAP is 0.8. Now, using the same value for the risk-free rate and the return on an average stock, then the required return on GAAP, what was it, 5 and 13, I think? Would be 11.4%. Now the CAPM, the required return, is the point right on the line. So the return we require would be 11.4%. Now, if it happened that we calculated the expected return and we find that the expected return on GAAP also was 11.4%, that would plot right on the line also. And that would mean the stock is neither overpriced nor underpriced. As Goldilocks said with the third bowl of porridge, it would be just right. The price would be just right. But that's the concept of equilibrium. There are two conditions you could think of. That is, with equilibrium, the expected return and the required return are equal. But you could also say the stock is neither overpriced nor underpriced. Are you with me on this so far?
Yes, sir.
Okay. I think I played with this with you before in class to show you what money might grow to by the time you retire. I'm pretty sure I've already done this. Actually, this is not even part of what you would be tested on anyway. We're touting the CAPM like it's cast in stone. It's not widely accepted in industry. Companies use versions of it. They use betas and other variables to try to come up with what they think their stockholders require. To be honest with you, this particular slide has two questions on it that I should not be asking a principal's class. So you may ignore this. Fair enough?
Yeah.
I finished up the chapter like I do most of them with a bunch of questions, which also reminds me, I want to walk through the risk quiz I sent out to you. That was when we didn't know we were going to be converting to online, but I'd still like to walk through it with you. But first, do all stocks provide a dividend yield and a capital gain yield? Another way to say it, do all stocks pay dividends?
No.
No.
So all stocks don't provide both a capital gains yield and a dividend yield. All stocks provide a capital gains yield. All that has to happen there is for the stock price to change. And stock prices are always changing. Can either component of return, the dividend yield or the capital gains yield, be negative?
Yes.
Yes.
Yeah. Which one?
Capital
Yes.
gains can be negative.
Capital gains yield. All that has to happen is for the stock price to drop, like it has been. What's the weakness of using the standard deviation of return as a measure of a stock's risk? It ignores portfolio diversification effects. It ignores the fact that when you throw this stock into a portfolio, about half of its risk indicated by the standard deviation disappears. That's what we call the unsystematic risk that can be diversified away. Standard deviation doesn't reflect the risk that can be diversified away. What's the variable that we use to represent market risk? Well, in the CAPM, which variable represents market risk? Beta, right? What's the beta of an average risk stock?
1.
How many stocks do you need to be well diversified, to essentially be rid of diversifiable risk?
20 or more.
About 20 or more. Sorry, that was supposed to be a plus. One of the downsides of trying to write on PowerPoint slides, PowerPoint itself is unstable when you try to write on the slides. I've read a blog about this. Even practitioners are going nuts over this. If you only need 20 stocks, why do institutional investors like mutual funds and pension funds, why do they invest in several hundred stocks instead of just 20? So that they won't have so much invested in any single stock that they can't sell it and the market absorb it. If you've got a $20 billion pension fund and they try to put that over, spread it over 20 stocks, you've got $1 billion in each stock. If you decided as a pension fund manager that one stock was overpriced and you wanted to sell it, the market wouldn't absorb $1 billion of stock dumped on it. So institutional investors diversify way beyond 20 stocks so that they don't have so much invested in any single stock that they can't sell it. Beta is found by graphing a stock's returns on the market returns. And what do you call that line? We'll squeeze it in up here. It's called the characteristic line. We graph the characteristic line to get the beta of a stock, to determine what a stock's beta is, and it's the slope of that line. Then we use the security market line to figure out what our required return would be. And the security market line is another name for the CAPM. The higher the beta, the higher the required return. And what do we call the line that shows the trade-off between market risk and return? That is the security market line. it's not static. It is dynamic. It's constantly shifting every day. Either the risk-free rate is going up or down, which makes a parallel shift up or down, or investor aversion to risk gets worse, in which the line gets steeper, or investors become less averse to risk, in which the line gets flatter. But it's constantly changing. What are the two basic assumptions of the CAPM? That investors are well diversified and that they are risk averse. Risk averse, faced with higher risk, they have a higher required return. And the CAPM shows us that. Remember, with the CAPM, the required return showed us that if the beta goes up, the required return goes up. So that's what we mean by risk averse. Is the CAPM used extensively in industry? No, but for one simple reason. It's next to impossible to test. And I won't get into that. Actually, you know what? You can forget about that question. You can forget about. And the next one, you can forget about. And the remaining questions. Those dealt with something called the arbitrage pricing theory model, and that's not something we cover. What is typically used as a proxy for the market return? We use the return on the S&P 500 index. What is that? That's an index comprised of 500 stocks. And we assume that's a good representation of the return on all stocks. What do we typically use as a proxy for the risk-free return? We use the return on Treasury securities, U.S. Treasury. We think of those as being risk-free. What's the term for the amount by which a stock's required return exceeds the risk-free rate? That's what we call the risk premium. The risk premium for Treasury securities is 0 because the return on Treasury securities don't exceed the risk-free rate. They are the risk-free rate. But the higher the beta of a stock, the higher will be its required return, so the higher will be its risk premium. And for that matter, what is the relationship between beta and required return? Positive. The higher the beta, the higher the required return. Which is greater if a stock is underpriced? The expected return or the required return? If the stock is underpriced, that means it's a good investment, right?
Yeah.
So the expected return would be higher than the required return. And likewise, if a stock was overpriced, that would mean its price is too high, which would mean its expected return is too low. If a stock is overpriced, the expected return is below the required return. Where do acceptable investments plot relative to the security market line? Do they plot above the line or below the line?
Above the line.
Above the line, yeah. The expected returns. Plot above the line. If I write fast, it gives me that dash out to the side, and that's a glitch in PowerPoint. Which industrial segment is populated by companies with above average betas? Would you say durables or non-durables? That would be durables. That would be companies that make or sell products that are expected to last several years. Cars, appliances. So which segment would be populated by companies with below average betas? Those would be your non-durables. Like clothing stocks, food stocks. Those would be companies that either make or sell products that are expected to last less than a year. All right, be patient with me while I try to pull something up the dean wanted me to go through with you. That's the end of this chapter as far as the lecture goes. What you guys should be trying to do is work the slides that have problems that are green in green ink and try to work the problems assigned out of the book. Now, you can, let's say you try to work a problem out of the book and you don't get the check figure in the back. Appendix B has the check figures for the problems I've assigned out of the book. And if you don't get the check figure, there's one of two things you can do. You can go to the Moodle site for the class. And for example, if you're working a problem in risk, you'll notice there is a, guys, I haven't been playing with this thing on the Moodle website, but look under risk and return, and you'll see a green call out icon that says, ask the professor, classmates. Click on it. And it'll take you to a place where you can ask a question. Add a new question. And All right, my handwriting thing is not writing, but I'll try to type it. Let's say problem, in chapter 8, maybe problem 3, and I have no idea what 3 is. But down here, you can, write out your work. Then post it. And I or anyone else in the class can respond. Click on it, reply, and this is what you did wrong. And then go ahead and type it out. The other thing that you can do that's not as labor intensive, interesting. Here we go. Do it this way. Write out your scratch work on a sheet of paper. Take a picture of it with your camera phone and then email it to me. And I can respond. And you may find that to be a lot easier. Your phone automatically will save it as a JPEG file. That's one I can write on when I get. All right, I ask you for your patience for one more thing. And I'm going to have to pull it up. I apologize. All right. You're getting a look at my inner workings here. Or maybe not. I don't know if you can see what I'm doing or not. All right, where's there it is. Okay. I can discard that. We're, sorry guys, 1 second. There it is, that's what I'm looking for. Share, all right. And there's a quiz. Can you see this Word document that starts risk and return concepts?
Yes.
Yeah.
Cool. Thank you, Hutch, for the affirmative answer. Look at question 1, the tendency of two variables, say the stock price of Microsoft and the price of Kroger, to move together, or for that matter, opposite, is what? Called what?
Correlation.
Positive correlation.
Correlation. And of course, if they tend to move together, we call the correlation positive. If they tend to move opposite, we'd say the correlation is negative. And the actual measure we have for that is called the correlation coefficient. and it can range from a value of a -1 to a +1, or anything in between. What's the average correlation between typical US stocks? If you just randomly grab stocks, excuse me, statistics may use R for correlation, which would be confusing here. Or it may use, well, I'm going to try rho. The average rho between US stocks is a positive 0.65. Most stocks are positively correlated. It actually makes sense. If today Microsoft analysts look into the future and they think Microsoft sales will be higher, profits will be higher, stock will go up. But if Microsoft thinks sales will be higher, that's because the economy outlook is stronger, and that'll tend to make most stocks revise their forecast profits to a higher level, and their stock prices will go up. Note that the fact that the correlation is less than 1 means that you do get some diversification benefits. It's worthwhile to diversify, even though the correlation is positive. All right, a correlation, question 4, correlation coefficient, a negative correlation coefficient indicates that two variables move what, in the same or opposite directions?
Opposite.
Opposite. Like, well, I use this example in class, the price of movie tickets and movie attendance. The higher the ticket price, the lower will be the attendance. So they'll be negatively correlated. And the author, our illustrious dean, made one mistake. Scratch that negative out for question 5. Strike out the negative. A positive correlation coefficient indicates that two variables move in the same or opposite directions. The same. All right. A perfect positive correlation is one where two variables move together in the same direction and by the same proportion. In other words, if we're talking about two stock prices that are perfectly positively correlated, that would mean if one goes up 10%, the other goes up 10%. If one goes down 3%, the other goes down 3%. They move exactly the same. And that would involve a correlation coefficient rho of a +1. And the thing about perfect positive correlation is you don't get any diversification benefits. If you've got, let's say, 2 airline stocks and they're perfectly positively correlated, they move in the same direction at the same time to the same degree, up and down. They don't give you any diversification benefits, so you wouldn't want to put them together in a portfolio. A perfectly negative correlation is where two variables move exactly opposite to the other in the same degree. You know, let's take ticket prices and movie attendance. Perfect negative correlation would be the case where if ticket prices went up 10%, movie attendance would go down 10%. If ticket prices went down 4%, movie attendance would go up 10%, but they move exactly the opposite. And that correlation coefficient would be a negative 1.0. And if you try to look for it in stocks, you won't find it. All stocks tend to move together, just not perfectly. So if you were building a portfolio, question 8, which combination of stocks would give you greater risk reduction? Which would have lower risk? To combine two stocks that have a correlation coefficient of a plus 0.7 or a negative 0.7? Negative 0.7. Your correlation coefficient can range from a +1 to a -1 and anything in between. The lower the correlation coefficient, the greater the risk reduction. So if I threw together two stocks that had correlation coefficient of a plus 0.7, I wouldn't get as much risk reduction as putting together stocks that had a correlation of a negative 0.7. Good grief, as Charlie Brown said. We're done for the day. Unless you guys have questions, and I'm glad to take them. Except for my pattern of speech, which I can't do anything about. How is this working? Do you feel like you're getting as much out of this as you would me going to the board in the classroom?
Yes, sir. So far, so good.
Cool.
Doing pretty good.
Remember, you can email questions to me. You can put them on the Moodle forums. You can even write on scratch paper, problem attempts, whatever. Take a pic, as I said, with your cell phone camera and email it as an attached file. And my email is, the one good thing about having the name Cudd, it's a really short email address, cudd@mc.edu. All right, guys. This will be recorded. I'll post it to Moodle. You know what might be easier is if I just email the link to you. I'll get the recording of this sometime tonight from Zoom. Then it will take a couple of hours to upload it to YouTube. When I get the YouTube link, I will either post it, to the Moodle class page, or I'll email it to you. The only reason I'm saying email it to you with hesitation, I'm not sure if that'll work, but we can try it both ways and see if it does. So you shouldn't get this recording till sometime tomorrow, probably tomorrow afternoon. Did you catch it that we're meeting only Mondays and Wednesdays?
Yes, sir.
Yes.
And theoretically, we can meet for 75 minutes If any of you have an 11 o'clock conflict, you can always leave the meeting and still look at the recording and not miss anything. So when do we meet again?
Wednesday at 10.
Wednesday at
Wednesday
10.
10. I'll have to set that meeting up and send you the link. By the way, you can always use, and I'll send this to you, my account number with Zoom. I mean, it creates a unique link, or you can click on my account number. So it may be simpler if I just send you my account number, and then you'll have it for the rest of the semester. Anything else? Stay safe. Bye-bye.
Bye.